What's up, everybody? It's Lincoln here with Tagger Finance. I'm jumping into the second options trading strategy in our three-part series on the three option strategies everybody should be using. This one is going to be on selling cash secured puts. This is by far my favorite strategy and one that I think everybody should be using on a consistent basis. My first video was on buying deep in the money calls. I use this one sparingly. I don't quite have the account size that I would like to be trading those on a regular basis, but selling cash secured puts is something I do very regularly, and it's something that I think almost everybody should be doing. So I was talking to this guy yesterday about his different investments and what stocks he liked, what companies he liked, and he was talking about McDonald's and how he'd held them for 15 or 20 years or something like that. He was talking about how he'd like to buy more, but the price is too high right now. He doesn't want to pay whatever McDonald's is sitting at. Let's check what it is right now. So he likes everything about the company, he just wishes it was a little bit cheaper. So I asked him if he'd ever heard of selling puts, and he hadn't. So I took that opportunity to kind of tell him about it. So you can see McDonald's is at $2.29. I think he said if he could buy it at $200, he would love that. So I basically kind of went over selling puts. So selling puts is just an absolutely fabulous way to collect option premium, to generate you income while you wait to buy stocks at your price. So like this guy, you might have found yourself locked out of buying a quality stock because it's above your buy price. You can end up sitting on your hands waiting, and whether it keeps going up or if it trades sideways and just never quite gets down to your price target in mind, if it's the 50-day moving average you're waiting for it to get back to, there's a way to get paid while you're waiting for it to drop. So this is a strategy that you want to use on stocks that you'd be buying anyway. I see a lot of people trading like the triple daily bulls and stuff like that just to collect really high premiums. Those trades can go against you and will go against you eventually. So make sure these are companies that you're fine holding anyway. And if you're doing that, then this strategy cannot lose. You will always outperform a long-term buy and hold, except for one very rare scenario, which we can get into at the end of the video. But for the most part, this will always outperform. So if someone offers you cash today for an opportunity to buy your favorite stock at a lower price than where it is now, would you take it? That's kind of the question at hand. That was the question I asked my buddy yesterday. So I said, hey, if I was willing to pay you $1,000 to buy McDonald's at $200 by this Friday, would you take that deal? And of course, he said yes. So that is the question you need to ask yourself. Are you willing to get paid to wait to buy your favorite stock at a price target that you set? So that's what selling puts is all about. So I'm talking specifically about cash secured puts, depending on your brokerage. So like McDonald's right now, if you sold the $200 put, you would need $20,000, basically committing to buying 100 shares at $200. So you need $20,000 in cash. Obviously, different accounts let you take on margin, and that just opens up a new realm of risk that you don't really need to take. So I always recommend cash secured puts. So here's kind of the summary. You're getting paid to buy your favorite stocks. You're basically waiting until those stocks come down to the prices you choose. So in this example, it was McDonald's at $200. And then you're making very, very good returns. So this is something, as interest rates are at rock bottom right now, and people can't get a rate of return anywhere, whether it's CDs or bonds or let alone savings account or something like that. And I mean, dividends are great, but selling weekly puts just generates way better returns as long as you're willing to take the risk of owning 100 shares of the stock. So make sure you have plenty of money in your account. Make sure you're not over leveraging, overweighting one position too heavily. This is a great income producing strategy. So again, I want to repeat, do not sell puts on stocks that you don't want to potentially own. Only execute the strategy for quality stocks that you want to keep in your portfolio anyway. You would be perfectly content owning 100 shares of it. I cannot stress this point enough because trades will go against you and you will end up holding these. And if there are companies that you don't like and you just sold them for the premium, they're going to end up sitting on large losses. I mean, you can start selling covered calls against those. But if it's not companies that you believe in for the long term, you could end up losing money and losing a lot of money. So that is that for the disclaimer. So what's exactly happening when you sell a put? The terms of the put selling contract require you to buy 100 shares of McDonald's at the stated strike price. So in this scenario, it's $200 at any time until the option expiration date. So I'll jump into a real term example here in a couple minutes of a trade that I'm making in the Robinhood 1K challenge. If you guys haven't seen those videos, go ahead and check them out. I absolutely got off to a terrible start in week 1, but I'm going to get back to the basics and kind of focus on the trades I do best. I kind of got caught up in trying to get off to a hot start, and it cost me. So we will be clawing our way back so you guys can watch me do that in those videos. So how do we get our shares? So let's go back to our McDonald's example. So say tomorrow morning at market open, we sell that $200 put at, let's actually see exactly what these are. Okay, so you can see that $200 put, it's pretty cheap. So maybe this isn't the best example. Let's use the 210 for example. So this is selling for 14 cents contract, so this would be worth $14 if we were to go ahead and sell this. When you're selling a put, you're basically agreeing to buy the stock for this whatever your strike price is. So between now and Friday, if I were to sell this, I would be committing to buy McDonald's for $210 and 100 shares of that. So I would need $21,000 of collateral to make this trade. You can see that once I click through here. So there's $21,000. It's 100 shares times your strike price. Okay, someone is buying the right to sell me these shares, and they're not going to sell me these shares at $210 unless McDonald's is at or below $210. If McDonald's stays perfectly flat this week and closes on Friday at $230 a share, why would they sell it to me for $210 a share? So in order to actually be assigned these shares, it's going to have to expire at or below that strike price. So if you want, I'll just jump into the part where selling options can go against you. So say you're very, very bullish on McDonald's, and especially so in the short term. So the only time I wouldn't sell a put before buying the shares is if I was very, very bullish in the short term. So say McDonald's is at $230 today, and you think it's going to go to $250 by Friday. So if I sell this 210 call right now, I'm going to collect $14. Whereas if you were to buy the 100 shares at $230 today and it goes to $250 by Friday, that is a $2,000 gain. So if you're very, very bullish in the short term, you're way better off just buying the shares immediately. Another strategy would be to selling an in-the-money put. So say you only think it's going to go to $235 by this Friday, which would still be a nice gain. But you want to for sure own the stock by this Friday. So you can go ahead and sell an in-the-money put. So you can see I can sell this, commit to buying 100 shares at $240 a share, so $24,000. But I'm going to collect $1,000 in premium up front. So I could sell that today, and if McDonald's closes at or below $240, that's going to get assigned to me, and I'm going to get those 100 shares. When I hold them in my account, it's going to show that I bought them at $24,000, but don't forget to subtract this premium that you took in. So you can see your break-even's actually $229.80, which is only slightly above where this is at. So this wouldn't be a good one to sell right now because you'd be paying more for it than it's worth. But if you go ahead and sell this 237.50, that's a better example. You can see the break evens at 228.67 as opposed to buying 100 shares at 229.37, and you're still more than likely going to get assigned those shares. So if you for sure want to own them in the short term, you can always sell that in the money put, one that makes sense, one that lowers your cost basis a little bit, and you will be better off than buying the 100 shares outright. So just to reiterate, the reason I love the strategy so much is because people are paying me for the opportunity to buy my favorite stock at a price of my choosing. So anytime you can get paid to buy your favorite stock at your choosing, I'm going to take that all day long. So a lot of people look at options, both buying, when you think about when you buy puts or buy calls, you're basically gambling, especially short-term ones, you're basically gambling on the direction that that's going to move. When you're selling calls and puts, you're basically becoming the casino and increasing your odds exponentially. And this strategy also allows you to make money whether the stock goes up, it's neutral, or if it's slightly down. So you can see, even if we sell, just say we sell the 230 put, our break even is actually at 227.13. So the stock could go down all the way to 227.14 by Friday, and we are still collecting that entire premium at $287. So it allows you to make money if the stock goes up. Obviously, it is a bullish position, but it does give you a little bit of breathing room on the downside. So you can make money up, down, or sideways. And also, if you're selling out of the money puts, you got time decay. So you can see the theta here every day. This is going to be worth 18 cents if the stock doesn't move. So if we sell this for $1.80 tomorrow morning and the stock closes on Monday afternoon at 229.37, this is going to be worth $18 less. So this is going to be at $1.62. So there is 18 cents for nothing, for no movement. So you have time decay working in your favor as long as you're selling those out of the money options. So I hope you guys can see the power behind the strategy, the reason I like it so much. Like I said, it is by far my favorite strategy. You're buying your favorite stocks at prices that you choose, and then you're making good returns to do it too. So let's go ahead and jump into my example. This is going to be how to do it with a small account, how to sell cash secured puts with a small account. It is possible. If you are doing this in a small account, unless you're trading stocks with really low prices, you're going to have a hard time not being overweight in that particular play. So I wouldn't recommend doing this for everybody unless you're very, very bullish on the stock and you'd be buying 100 shares anyway. So don't over leverage yourself on any one position. I think the key to diversification is never own enough of a stock to make a killing and never own too much of a stock to get killed by. So, if you have $1,000 and you're trading a $600 or $6 stock, and if you bought 100 shares, you have 60% of your money in that one play. That is not near enough diversification. So just keep that in mind. If you do end up doing this, you are basically playing with fire. That is a lot of risk. So keep that in mind. Here is the trade that I promised. It is a screen recording on Robinhood. So here it is. 3D Systems. I talked about this in my first Bulls versus Bears video. I showed a couple of the fundamental reasons why I really like this company. It had a huge run up this week. I'll show the technicals here. You can see it bounced. It's definitely getting bought up by some institutional buyers. I don't mind it at these prices, but I really like it at $6 a share. So I thought this was a perfect one to go ahead and sell a put on. You can see me check the volume and make sure it is going to get filled. So I put this in for 25 cents. You can see collateral $600, 100 shares at $6 a share. So let me pull open my calculator real quick and we'll run the numbers behind that. Alright, so it is $25 divided by that $600 in collateral. You can see that gives us a 4.16% return. We multiply that by 52%, and that is a 200 and almost 17% annualized return. So that option did end up expiring worthless. Like I said, 3D Systems, it's a company that I really like. I talked about it in a previous video. I would be very happy to own that at $6 per share. So that's the strike that I chose. It traded about 40 to 70 cents above my strike price the entire week. So I was never really nervous about getting assigned these shares, although I wouldn't mind getting assigned these shares at $6, like I said. So that is a trade that I am actively making and will likely do in the next episode of the Robinhood 1K Challenge. So that is it. Thank you guys for watching. I hope you guys see the power of this strategy and how beneficial it can be. I did talk my buddy into selling puts, so even though he considered himself a long-term buy and hold investor, there's no reason that this strategy can't help out his returns. And it's the same thing with McDonald's. He said he wanted to buy it, but he didn't want to pay more than $200 a share, whether it's picking a specific entry point like that, or if it's based on technical analysis, you think it's going to pull back to its 50-day moving average in the short term. There's no reason to have to just sit there on your hands and wait for it to come back down. Sell your puts at those strikes that you're looking for it to come back down to, and collect some premium in the meantime. And again, I cannot reiterate enough, only sell puts on stocks that you would be buying anyway. Okay? Don't just trade for the premiums. There is a lot of people on YouTube right now telling you to sell puts on the triple daily moving bull mid-weighted market cap or whatever. If you would not be buying that ticker anyway, then do not sell puts on it for premium. It is not worth it. You will end up holding these stocks at one point or another. It is inevitable. So make sure it is stocks that you want to hold anyway, and that you be buying at least 100 shares in anyway. Thank you guys for watching. If you guys can hit the like button, that really helps out. You can subscribe if you're new and follow along. I got a Robinhood 1K challenge. I'm looking forward to making only a couple trades this week, so looking to get about 3% back this week. And if we do that, we'll consider that a success. So if you guys have any questions, feel free to let me down in the comments, and I will catch you guys in the next video.